All right, everybody. Hopefully, everybody's gotten a chance to get settled in and gotten in. But I will first off want to say welcome to the 2023 Financial Planning Market Update live webinar hosted by your friends here at Beacon Financial Strategies. Before we get started on this event, I did want to say thank you to everyone who's joining us today, and thank you to everyone who's watching the recording. Before we get started today, we're going to go over a few housekeeping items. So this webinar is designed to be informative in nature, not to recommend a strategy or give advice. There's a lovely Q&A message box. If you have any questions throughout the event, please don't hesitate to ask a question. I'll be kind of monitoring those, and we'll get those to our hosts, which brings up our next topic right here. Our hosts of today's webinar are Chip Heimiller, Aaron Campbell, and myself, John Motto. So kind of before we get into the meat and potatoes of today's presentation, I did want to give a couple reminders. Your investment strategy should be based on your long-term financial plan. Portfolio risk and returns are based on the stock bond mix of a portfolio. Research has shown that portfolios benefit from a globally diversified approach that manages frictional cost. So without any further ado, Chip, I'll hand it on over to you.
All right. Thank you, John. I really appreciate that. And welcome everyone to this webinar. Just to reiterate kind of what John says, just know that, we're going to be talking about things that are, almost forward-looking in some cases. And so just a disclaimer that I know there's people who are clients of ours, and there are also people who are not clients on this webinar. I just want to make sure that this advice is kind of designed to be very general in nature. And so just keep that in mind kind of as we go through this presentation. So first, I'm going to start us off talking about some investment themes that are impacting the financial markets. And then after I kind of wrap it up, Aaron's going to come back on and talk about some financial planning opportunities and strategies that would be relevant to actually a lot of people. So stay tuned for her messaging, and we'll get started. Just know that we're going to be a little bit in the weeds here on the investment side. A lot's kind of happened in the past year or so, and we just kind of want to make some observations and provide some data, and hopefully you'll learn something along the way. So I'm going to be talking about the financial markets and the things that are really impacting the markets right now that we see, and three of those things I think include the Federal Reserve's current policy and outlook in the future, stock valuations and kind of where things are now, as well as some geopolitical issues and items that create uncertainty. So let's get started. And I wanted to talk first about the bond market. Okay, so that has been one of the things that has been pretty extraordinary here in the last year or so. And this is just a graph of returns for the Bloomberg U.S. Aggregate Bond Index, which is just an index that owns corporate bonds and various maturities and credit qualities and that kind of thing. But over time, you can see here that if we just glance at this, it's a lot of blue, which is the positive years, right? There's a few negative years mixed in between, but what's happened in the last couple of years has been pretty monumental. Last year, this particular index was down, 13% or something. So that's a pretty big switch from what we have seen over time. And this is year to date as of September 30th. I think now this index is in the blue again. So that's great. But what's happened in 2022 was a big deal. Just as the Fed was raising interest rates, bonds performed pretty poorly, historically poorly. So just wanted to point that out, and kind of if we look at a little bit more granular basis at bond returns, we've kind of looked and segmented things by long-term bonds, intermediate-term bonds, and short-term bonds. And these are just like a global or just a bond index. Okay, so long-term bonds year to date are negative. So this is the zero, and you can tell bonds, long-term bonds that are very interest rate sensitive, have negative performance year to date, and that's kind of to be expected just based on what's going on with the Fed's posture towards interest rates. Intermediate term bonds and shorter term bonds have performed okay this year. Just the expectation of things starting to stabilize and that sort of thing. But due to the fact that last year was so terrible in terms of returns, 3-year returns look really bad for just about every category, right? Long-term bonds are really negative for a 3-year annualized through November 14th. Intermediate term bonds were negative as well, for the 3-year period. And also short-term bonds have been negative. 10-year returns look a little bit better, but if you really think about it, a 2%, a little bit more than a 2% return on a long-term bond is not really great, but it's really a function of the fact that interest rates have been really low, right? We've had, very low interest rates for a really long time, and we'll hit more on that here in a second. I think it's an important thing to understand that, this correlation between interest rates and bond prices, right? So as interest rates rise, bond prices decline, right? And that's something that is, an interesting phenomena. And it makes sense, right? If you have a 3% bond that you own, and new bonds are being issued that pay 5% yield, if you need to sell your 3% bond, you're going to have to drop the price of it in order to sell it, because who would buy your 3% bond when someone could, just go out on the open market and buy the 5% bond? So just keep that in mind as we talk further, because, the opposite of that happens as interest rates decline. All right. So as interest rates decline, bond prices subsequently rise. And that's kind of a good thing if you own bonds. So we'll talk a little bit about that here in a second. But first, I want to talk a little bit about what has happened recently. And this graph really shows the federal funds rate over time since about 1999. And you can see here, I've made little notations about what's happened during different periods. And the Fed has, intervened and started cutting rates in these really important moments in time, right? The tech boom and bust, the Great Recession, and then COVID-19. All of those things warranted some monetary action. And the Fed kind of intervened at those moments in time and cut interest rates. And that ended up, the idea there is to spur the economy, to stimulate the economy. And that was very effective, right? But after the Great Recession, interest rates were low for a really long time. And, eventually the Fed started trying to raise rates to get back to a more normalized interest rate posture. But then COVID-19 happened, right? And, so they had to go right back down to zero rates. And a lot of things happened during this period of time that impacted, our economy and our lifestyle, honestly. And so, there was supply chain issues. There were, pent up demand. People had cash because of stimulus payments and PPP loans and that sort of thing. And so the demand for goods and services became really high, and inflation kind of creeped into the system. And so to respond to that, the Fed wanted to take efforts to start constraining the economy, because doing that has the effect of tamping out inflation a bit. And so the Fed back in, late or early 2022 really started hiking rates in earnest. And, today, this is where we are today, kind of at this, 5.25%, the 5.5% range. And so that's kind of the progression of Fed's interest rate policy over time. But you can kind of see here, this last segment is really projections of the future. Okay, so the Federal Open Market Committee has their own estimates of what they expect interest rate, the federal funds rate to be going forward. And you can kind of see that we're at a point where, assuming nothing changes, we're at a point where the Fed feels like, okay, we're restricting the economy enough. Inflation is not been eliminated, but it is slowed down dramatically. It's still not at where the target that the Fed wants. They're kind of targeting a 2% inflation rate, and I think we're somewhere around 4 right now. But this is what is projected. Now, anything can change in the future. You shouldn't base your borrowing decisions or anything like that on these expectations. But it is interesting to note that the expectation, the general consensus expectation is that interest rates will ultimately go back down a little bit, at least. I don't think we'll see, I hope we don't see 0% interest rates for a long time, because that means we've got some serious economic problems. But at least for now, I like these projections, the idea that, okay, at some point we can get back to a more normalized interest rate environment. So I just want to talk a little bit, have a little bit of a summary of what our thoughts are here. The good part with higher interest rates is that the returns for bonds should be higher going forward, right? So, that's a kind of a good thing. We've had conversations and meetings with clients over the last basically 10 years about how frustrated we are about the zero interest rate environment. People who are savers and who are conservative savers especially have had a hard time earning returns. And at least for now, rates are really great. And we want to just make sure that we can take advantage of that. Also, as the Fed approaches kind of this end of their interest rate hike initiative, it may be appropriate to kind of lock into some of these higher rates, right? Because, we don't expect higher interest rates to be around forever, right? And so, positioning the bond portion of your portfolio in a way that can kind of lock into these longer term higher rates and potentially capitalize on a declining rate environment is something that, we're considering here. And we've already made some adjustments for clients, but, it's one of those things that you should definitely consider. The other thing that's often overlooked is credit quality plays a really important role when it comes to bond investing, especially now as, the Fed has taken action to slow the economy. So as the economy slows, certain companies can run into some problems with debt repayments and things. I know commercial real estate is one that's in the news of having some problems. And so, make sure that, the bond segment of your portfolio has credit quality that's appropriate for you. We tend to be very cautious in that area because our clients really use the bond segment of their portfolio to fund distributions and provide liquidity and stability and that sort of thing. So those are just a couple of thoughts there. John, I'm wondering if I have any questions.
Yeah, perfect timing, Chip. You actually have a really good question here. Are interest rate hikes and cuts, is that the only thing that moves, that causes bond prices to move?
So no, it's not. There are other things that cause bond prices to move. And the biggest one is credit quality, credit ratings changes, right? So if you have a situation, let's say, where a company is, let's say Exxon, we've got Exxon, their bonds are, AA plus rated. And I'm not sure exactly what they are, but this is an example. Well, let's say that they have an accident and there's a giant oil spill, right? There's an oil spill in the Gulf. And now it's a situation where, okay, what's the cleanup cost? What's the environmental impact? What's the punitive damages that Exxon's going to have to pay? All of these things, well, ratings agencies will come out and say, oh, Exxon's no longer an AA plus rated bond. We're going to cut the quality rating to a, BB, or a triple B or something like that, well, then that would have a negative impact on that particular bond. Okay, so that is, one of the things that changes the prices of bonds. It's a kind of a complicated area, honestly, but you want to be careful about credit quality. That's kind of the last point that I had with that. And so, but bond prices change depending on, credit quality issues, also supply and demand. If you just have one specific industry where people want to invest in bonds, that could drive prices up on the bonds that they have, right? The companies have a demand for the bonds that they are issuing, and so the interest rates would go down, prices would rise, going back to that little table we saw. So that's the answer to that question. Are there any others, or is that it?
No, that's all that we have for now, but I would invite our participants to keep them coming. That was a really good one.
Yeah, any questions that you have, don't hesitate to just enter it in the chat box. We're happy to answer those questions. All right. So now I wanted to turn the page a little bit to stocks. Okay, so here's the performance of, really indexes and categories of stock indexes, right? And we just kind of broke it up to large cap US stocks, US small companies, and then international stocks. Those are our three primary categories. We're just trying to keep it simple. And you can kind of see returns have been, pretty good actually year to date. If we look at like the S&P 500 or a total market index, these are have done very well this year. All right. In fact, U.S. large companies have led the charge in all of these time periods, right? And so that's one thing I wanted to bring up with people. U.S. large cap stocks have done well for a really long time relative to smaller cap stocks and international stocks. Well, one of the things that, if I'm an investor, it might seem natural. Hey, why are we even investing in international and small cap companies? Because they're actually higher risk investments, right? I mean, smaller companies, you have to assume that they're a higher risk investment than a larger company. And so for that, investors should demand higher returns. Well, all I can say there is that things tend to be cyclical. And over time, no one knows what direction and what types of companies are going to do best. And but over time, things tend to be cyclical. And so, the next chart kind of shows that, especially as it relates to international companies, right? And so this is a chart that shows the rolling 5-year returns of the return differential between U.S. stocks and international stocks. All right. So the light blue on this graph shows that international stocks have outperformed U.S. stocks during these time periods. Okay. So whenever you see this light blue below the 0% line, that means international has outperformed U.S. All right. But what we've seen most recently in recent history, we've seen this dark blue is winning, right? And that's U.S. stocks. The return differential on U.S. stocks has been greater than the returns of international. And so the point of this is just to show, hey, things tend to be cyclical. U.S. stocks will not always outperform international. Now, there's been some international issues that have happened now with Brexit and some other things that have caused some of this. But over time, things tend to be cyclical. And so I just wanted to kind of point that out. And, we adhere to kind of a globally diversified portfolio. Of course, everything is, based on specific client issues, and we customize portfolios based on disbursements and preferences and all those things. But by and large, we like to see globally diversified portfolio. It just makes sense from a risk and a return standpoint. And this is kind of why this chart looks like chaos, and that's the point here, right? Because each of these columns is a year, and you can see, which category of investments have won this year, right? And so in 2013, small companies did really well compared to, U.S. large cap and international markets and high yield bonds and, all of these different categories and asset classes. So, but we don't know which one's going to be the best. And, so to us, we'd like to see a diversified approach, right? And so the black boxes are the diversified portfolio, right? So it has bonds and stocks and different types of stocks and different types of bonds and international. And, it's never going to be the number one performer, but, that's okay, because what we're trying to do with the diversified portfolio is manage risk. We're also trying to create a portfolio that minimizes, some of the emotional biases that can happen to investors as we kind of navigate through difficult times. So anyway, that's a good chart that kind of emphasizes the fact, hey, we don't really know what's going to perform well each and every year. So let's own a lot of different categories of investments. All right. I want to hit a little bit on something that an observation, we'll say, that is something I think people need to be aware of. And right now, there's 7 companies: Apple, Microsoft, Amazon, Alphabet, which is Google, NVIDIA, Meta, which is Facebook, and Tesla. These 7 companies are the largest companies in the world, basically. And so, how in the last year or so, actually the year to date, these are the return numbers of these 7 companies, which, by the way, and they're called the Magnificent Seven. And over time, we see these a lot. It used to be FANGs was another term that these top stocks of the S&P 500 were called. But basically, these 7 stocks have really led the charge on returns. All right, and look at this year to date. These companies, if we just do a simple arithmetic average, the average return of these is like 100%. And they've really driven U.S. stocks forward. And these are great companies. Everyone should own some of these companies. But the observation that I want to make is that these are, if you look at the S&P 500 index, these are very highly weighted companies in that index because of the way that the S&P 500 is comprised. And the way it works is the largest companies in the world, and really the U.S. for the S&P, but the largest companies in the U.S. represent the largest percentage weighting of that index, okay? And so these top 7 stocks right now are just a shade under 30% of the weighting of the S&P 500. So I don't know about you guys, but my definition of diversification extends more than just 7 stocks, okay? So, I've said this a lot of times to people, and I have clients that will laugh when they hear this, but your portfolio is not the S&P 500. And the reason for that is for this very reason. We don't want to have the risk, the company-specific risk of any one company. Now, do we want to own these companies? Heck yeah, they're some of the best companies in the world. We want to participate in that growth. We just want to be careful about how much exposure we have there. And, just to take a look here at the impact that these companies have on the S&P 500. If you look here, this is the S&P 500's return year to date, right around 18% or so. But if we equal weight all of the companies, there's 500 companies in the S&P 500, 1/500th weighting for every single stock, the return would only be about 2.3% this year. So, these 7 companies have done a lot of good things for the S&P 500 index, whereas the other 493 are, they're participating in the gains, but just it's so much, such a performance disparity in that. And so, that kind of, a lot of people would ask, well, why is that bad? Why do you not want to own these 7 companies? I mean, it's diversified in a way, although I would argue that a little bit because, I see a lot of common sectors here, Microsoft and Google and, Apple, they're all kind of technology-based companies, and even Amazon and is a tech-based type of company, so even though it's a lot of retail too. So, but why wouldn't we want to own that? Well, the issue that I have is one of a valuation issue, right? And what does that mean? Well, if you look at common metrics if you look at metrics that suggest, hey, is a stock overpriced or underpriced? Is the return outlook very promising or speculative? If we look at things like price to book ratios, right? And price to book ratio, what this chart kind of shows price to book ratios of various indexes. Okay, so price to book ratios are simply a measure of the market's valuation of a company relative to its actual book value. Okay, the intrinsic value of a company. And so, for people who are looking at individual stocks or even, indexes, this is a measure of how attractive a certain investment is, right? We like price to book ratios to be pretty low. I would rather buy, something that's on the lower end with the idea that it can move higher, right? We can see the valuations move higher. Something that's on the upper end, I kind of say, okay, that's a kind of a warning sign. And, anything can happen. Things can change with companies, and we just need to be cautious of that. And this Magnificent Seven, these 7 stocks have a really, really off the charts high book value. Now, it's okay that, it's not to say, hey, we need to go and, drastically exit or anything. It's just something we need to be aware of. And when I'm thinking about allocating money and people being a little bit frustrated maybe with international markets, I can say, well, gosh, look at this. They've underperformed, but there's an awful lot of value here in some of these international companies, and they're priced really low compared to that. And so in the back of my mind, I kind of think, okay, well, this is a good sign for international. The valuations are kind of intact. And for an index like the NASDAQ or even those 7 stocks we mentioned, I'm kind of less enthusiastic from a pricing standpoint there. So I think that is an interesting thing to point out, and really a justification for why you may not want to own, only the S&P 500. You might want to think about, hey, let's look at other areas of the U.S. market that are undervalued and have some exposure there. I know that's kind of the way we do for our clients. All right. I want to hit just a second on all of this cloud of uncertainty. I'll tell you that it seems awful scary. I mean, there's a lot going on right now. There's conflicts, there's wars, there's a lot of uncertainty around election cycle, and Congress debate of budget deficit, and issues around climate change. There's a lot of things that's swirling around that can really distract you from the long term. And I just kind of want to say, hey, these are all things that are they're major issues, but they're things that ultimately are going to be resolved. And so we think that you can see that in this kind of chart that shows, hey, there have been a lot of things that have happened over time, but even actually those things help returns. Short term it stinks, but over time, that's where there's risk. I mean, there's risk in the markets. That's why you get returns on your investment, because there are risks, right? And so, but there have been all kinds of issues, geopolitical issues over time. And, this is the stock market. It just kind of marches up. It's not in a straight line though. So, we have to endure periods of uncertainty and declines, but ultimately things do reflect, go upwards and move upwards. And so I just wanted to remind people of that. I know there's a lot of uncertainty. People are awful worried for a lot of different reasons, and I understand that. But I also know that over time, companies are driven by profits, and companies who have great ideas and great services are going to benefit long term. And so just keep your eye on the long term, and things will be fine. So just in general, I just want to kind of summarize my part here by saying, the global economy is uncertain. No one really knows the direction that we're going. No one knows especially in the short term, right? No one knows that shorter term, the market's going to move in either direction. And there's a lot of people who pretend to know, but I can tell you that they don't know. No one knows what's going to happen there. And so our recommendation is to control the things that you have the most control over. And what are they? They are diversification. Let's diversify our portfolio. Let's eliminate company-specific risk. Let's invest in, shorter-term bonds and longer and stocks. U.S. stocks, international stocks, small cap. Let's be diversified. Let's take a tax-efficient investment approach. Let's invest in mutual funds and ETFs that are tax-efficient. Let's position people's portfolio in a tax-efficient manner. Which types of investments do you put in which account? Those are all important decisions. And most importantly, and this is one that leads up to Aaron's presentation, is take advantage of those financial planning opportunities that present themselves all along the way. That's how you leverage and benefit from the power of compounding over time. Take advantage of these opportunities on the financial planning side. And with that, I'll ask for questions and then kind of ask Aaron to kind of bump on as well.
So Chip, we did have one question, and it was about our last graph, which I have to admit, I really like that graph. So the question was, is the graph adjusted to for inflation?
Is the graph adjusted for inflation?
And
No. That's just a $1, a $1. Let me just go back and see if I can get back to that. This graph here.
yes.
Yes. No. This is a direct investment of $1 that turns into 80 over that period of time. Right. But it's still, $80, back in 1970 is worth a lot more than $80 today. So that's not the real return. That's the actual return.
Got it. Well, that was all the questions we had, and so I thank you, Chip. I really enjoyed that. I guess we can hand it on over to Aaron. What do you say?
I think that's great.
Hey, everybody. Thanks, Chip. That was great. Just wanted to spend a minute and talk about kind of tax planning strategies. It's the end of the year, so we're talking to a lot of people about what do we need to do here at year end. And some of these things you guys have heard me talk about before, heard us talk about before. So, things that we're thinking about, things that are on our mind: tax loss harvesting, charitable contributions, Roth conversions, and then overall just making sure people are maximizing their retirement plan contributions. So kind of the first thing is the tax loss harvesting. And so on the next slide, we'll talk a little bit about the fact that, you can sell off investments that have been at a loss. And in order to do that, you can kind of either offset gains or you can carry it forward. And so I think we need to go to the next slide if we can. I'm just not seeing it. There we go. All right. So you can take up to $3,000 in investment losses annually. And so we kind of say, well, we've had kind of a rough couple of years. Stocks have done really well this year, but maybe bonds, we sell off some things that have not done as well. And you sell it off and you can offset any gains you have, but you can also take a loss on the front page of your tax return, which can offset other income items. Capital losses are carried forward indefinitely with an asterisk. But you can definitely carry them forward and keep chipping away at it. So if you have a big loss, you can kind of chip away at it every single year until you use it up. So this is some things that we've been doing: placing trades, rebalancing in the portfolios, and then taking advantage of tax losses where we have them. The next slide, we'll talk a little bit about donor advised funds. So these kind of funds, some people might be aware of them, but basically you're setting aside your future charitable contributions. So typically what we'll do is we will move investments that are low basis, which means that we bought them a long time ago, or they were gifted to us a long time ago, and maybe their basis is really low and maybe they've now appreciated in value, and we'll move it to a donor advised fund. And so when we move it, we get a tax deduction, which is great. It's a charitable deduction. We can take it on our tax return. But you can spread out the gifts to the charity over a period of time. And so it's a way to take advantage of quote unquote bunching your charitable gifts. And so you may give a big chunk, take a big tax deduction, maybe in a year where you have a lot of income, but then you're not necessarily giving it to the charity, you know, that first year. You can kind of spread it out. So that's a really nice alternative for people to do. And then the next idea is to think about charitable contributions, and specifically qualified charitable contributions. So this is a little bit different than, you know, just giving directly to charity. This is for people who are over 70 and a half. So you have to be above the age of 70 and a half. And you take money from your IRA and you give it directly to a charity. You cannot give it to a donor advised fund. So I'll just point that out, but you can give it directly to a charity. We have a lot of clients that take advantage of this. When you give it to charity, basically what you're doing is reducing your taxable income. It's not a charitable deduction, but it's good because it's not income on the front page of your tax return. And you might say, well, what does it matter one way or the other? Well, there's a couple of reasons why it matters. One is Medicare premiums. Medicare premiums tend to be calculated and increased depending on your income. And then also right now we're in a situation where itemized deductions, or the standard deduction really, is so high that it's hard for people to itemize. And so it's really nice to be able to give away money to charity from your IRA and still kind of allows for the tax deduction. And for those over 73, which is now the age that you have to take a distribution from your IRA or 401k, these qualified charitable contributions do count as your required minimum distribution. So that's kind of nice too. So you're kind of hitting checking a couple boxes off all at once. So we really encourage people who are charitably minded to think about using your IRA for their charity, especially if they're over the age of 70 and a half. So, okay, now my favorite topic, Roth conversions. We talk about these quite a bit in client meetings. And so just kind of what are Roth conversions and why do we like them? Well, number one, it's pretty simple from the standpoint of you're taking money from your IRA and you're moving it to your Roth. When you do that, you pay taxes on the distribution from the IRA, but the hope is, well, and the way it is right now, future Roth IRA distributions are not subject to income tax. And so you're kind of taking the choice to pay the taxes now to avoid the tax later. Investment earnings and Roth conversions are completely tax exempt. You don't have to take required minimum distributions from your Roth. So that's really nice. They're really great for people to inherit, like your children and grandchildren. And so that all makes a lot of good sense. And so kind of the next slide we'll talk about is, when should I even consider these things? And so what we typically say is, if you are in a temporary low income tax bracket, and that may be because you lost your job or it was just a weird year, you didn't get a big bonus or something like that. It can be because you're in retirement. But there's a lot of different reasons. If your income is kind of low, it may be a good year to take advantage of this. If you have unused deductions, and so what that means is, let's say you have a mortgage or other things that, you know, it's kind of, mortgage interest is kind of a lot. You may be in a situation where you've got a lot of itemized deductions and you need to kind of have some income to offset it. People who know me well know that I don't love to see zero taxable income. So we're kind of trying to generate income in those years. Medical expenses could be high. Maybe you decided to give a lot to charity or to a donor advised fund. And so those things can kind of drive your deductions up. And so a Roth conversion is a way to offset it with other income. The sweet spot for us is usually kind of right before retirement, or right in retirement, but before Social Security. So I just point that out. This is kind of a busy graph, but I really wanted to point out why we are really beating the drum on the Roth conversions. And the reason is because we're kind of in a temporary period of time where tax rates are pretty low. Especially if you look historically. And so in 2023, right here, you can kind of see the bottom, 10 and 12%. All look fine. That 24% goes all the way up to well over $350,000 of income. And so that's quite the stretch. If you could look back at 2016 earlier in the graph, you could see that that same amount of income would have been in the 33% bracket. And so it's just something to think about. Well, what's going to happen is 2026 is the sunsetting of this tax law. And so if Congress doesn't do anything differently, this is what we would expect. And so we've only got a handful of years left to kind of take advantage of these Roth conversions at the level we're at right now. So we're trying as much as we can for people that we know that, hey, come 2026, 2027, we're looking at a 33% bracket. We might be looking at, okay, well, let's at least max out the 22%, the 24% right now and try to take advantage of the temporary lower brackets. And so it's just something that is on our mind, and that's why we've kind of been talking about these Roth conversions so much over the last few years. If we go to the next slide, the reason why we would kind of say, hey, why wouldn't we just convert all of our IRAs to Roth? And a lot of that has to do with Medicare premiums for a lot of people. So for those of you over age 65, we pay a lot of attention to this. The Medicare premiums is based in part on income. And so if we look at this, these are the 2024 Medicare premiums. So for people that, married that make below 200,000, you're going to pay $175 for Part B, which is, I think, about a $10 increase a month over last year. But if you kind of look, that's a big jump from 206, to it goes from 175 to 245. And so that's a big jump. It's a monthly premium. And so we're trying to kind of keep people's income under that 206 if we can. But of course, we're trying to say, well, this is all based on the 2022 tax return. We can't do anything about that right now, but we're trying to pay attention to this because we don't want to affect, for 2023 tax returns, 2025 Medicare premiums. And so it's something to keep in mind. If you're already in some of those higher brackets, then maybe we're not as concerned about it. We keep it, where you're at now, but it's definitely something that we think about when we're thinking about doing Roth conversions, not taking it so that you end up having to pay more per month on Medicare. Okay, and so that's kind of it for the people who are retired. I did want to kind of just briefly talk about the retirement contributions. So for those of you that are working, you still have the ability to contribute to a 401k, to an IRA, to a Roth IRA. These are the limits, the deductions you can take for contributing to a 401k. And so if you look across the board, for the first time in my career, actually, the 2023 limit went up by $500 across the board. So in every category. So if you contribute, 22.5 is the maximum this year for 401k. It's 23,000 next year. So it's just something to keep in mind and make sure your employer kind of makes the adjustment there. If you're over age 50, this year is 30,000, next year's 30,500, and that the IRAs and the Roths also went up. So 6,500 or 7,500 over age 50 are now going to be 7,000 and 8,000 next year. So make sure that you're kind of maxing out these. Your 401k is typically what I will tell people is their single largest tax deduction that's even available. And so you want to be taking full advantage of that if you can, and it's offered. And some questions we always get is like, well, my employer's matching 3% or 4%. Well, that doesn't count towards this 22.5 or 23. That's a separate category. So don't even worry about that. It's just the amount you're putting in. So, all right. I think that's what we've got. Any other questions that have popped up, or I guess, John, I'll ask you that question.
Yeah, so we did have one question come in, another good one. Is a Roth conversion a good idea for everybody?
Yeah, I get that question a lot. And I will say, while I'm excited about the fact that, brackets are temporarily low right now, they're not necessarily low for everybody. So if you're in your highest earning years, you might be in the 33% bracket already. And yes, in the future, that 33% bracket might be going up. But you may actually be retiring in 2 years. And so when you retire, you may be in the 24, 22% bracket. And so for that reason, I probably wouldn't consider Roth conversions for those types of folks. But everyone else, if you've got lower earning years, or we think that your income is going to be the same now as it is later, then it might be something worth considering.
Yeah, awesome. Well, thank you so much, Erin. I've really enjoyed your part. It doesn't look like we have any more questions on tap.
Okay.
So before we kind of signed off today, I really wanted to take this opportunity to remind everyone, if they haven't been to our insights page on our website, we have a plethora of information and content here. As you can see, we've got podcasts, web presentations, kind of like one we have right now, articles about just about all topics. So we really hope that you'll go there, if you haven't been already, for a place where you can feel like you can get some trusted information in a world where information is coming at you in all different directions. And as you can see up there in the top of your screen, there's a QR code. So if you scan your iPhone or your Android up there, it'll take you straight to the insights page on our website. And I think it's a great page and full of great content. But I think that'll do it for us here. I want to thank everybody for joining us today. I want to thank Aaron and Chip for from 2 great presentations. I know I got a lot out of both of those. If there's something that comes up later and you think, oh, wow, I wish I would have asked that question, please don't hesitate to shoot us an email. But that'll do it for us today. And thanks so much again for joining.